What happens when a bank lends money to a company it owns? At first, it may seem like normal business. But if that affiliate fails, the bank could absorb huge losses. That's exactly why Regulation W places strict limits on how banks extend credit, buy securities, and conduct transactions with their affiliates. In this lesson, we'll break down the rules that protect banks, depositors, and the financial system from excessive affiliate risk. Welcome to Understanding Regulation W, part of the Get It Banking Education series. In this module, we'll explore one of the most important parts of Regulation W, restrictions and limits on transactions between banks and their affiliates. If you work in banking, compliance, lending, or financial services, understanding these rules is critical. Regulation W is designed to ensure that banks operate safely and that their relationships with affiliated companies do not create unnecessary financial risk. Throughout this presentation, we'll examine how Regulation W limits credit exposure, regulates securities transactions, and establishes safeguards that protect both financial institutions and depositors. Let's begin with a quick introduction. Regulation W establishes limits on financial transactions between banks and their affiliates. These restrictions exist to prevent what regulators call risk transfer. Risk transfer occurs when a financially struggling affiliate shifts its losses or liabilities to the bank. Without safeguards, this could weaken the bank and threaten depositor funds. By setting clear rules for affiliate transactions, Regulation W helps maintain financial stability across the banking system. One of the most important areas governed by Regulation W is the extension of credit to affiliates. Extension of credit refers to any situation where a bank provides financial resources to an affiliated company. This can include loans, lines of credit, guarantees, or other financial obligations. While lending is a normal banking activity, problems can arise when banks provide excessive credit to companies within their own corporate structure. If the affiliate encounters financial trouble, the bank may become responsible for the losses. That's why Regulation W places strict limits on these transactions. Understanding how lending works between banks and affiliates is crucial for compliance. Banks must carefully evaluate any credit relationship with an affiliate. They must determine whether the transaction qualifies as a covered transaction under Regulation W. Covered transactions include loans, asset purchases, investments in affiliate securities, and other forms of credit exposure. Each of these transactions carries potential risk, which is why regulators require banks to monitor them closely. Proper credit flow management ensures that banks can support their affiliates without jeopardizing financial stability. Now let's talk about credit restrictions. These restrictions are designed to minimize risk exposure when banks extend credit to affiliated companies. Without these safeguards, a bank could provide unlimited financial support to struggling affiliates. That type of exposure could quickly weaken the bank's balance sheet. Credit restrictions ensure that banks remain financially sound and that depositor funds remain protected. By limiting how much credit a bank can provide to affiliates, Regulation W reduces systemic risk within the banking system. One of the most important features of Regulation W is the quantitative limits placed on affiliate transactions. These limits help ensure that banks do not become overly dependent on their affiliates. Under Regulation W, a bank's covered transactions with a single affiliate cannot exceed 10% of the bank's capital and surplus. And the total of all covered transactions with affiliates combined cannot exceed 20% of capital and surplus. These limits create a safeguard that protects the bank even if one affiliate experiences financial trouble. To determine these limits, banks rely on a key financial measurement called capital and surplus. Capital and surplus represent the bank's financial strength. They serve as the foundation for calculating exposure limits under Regulation W by tying affiliate transaction limits to capital levels. Regulators ensure that banks only take risks proportional to their financial capacity. This approach helps maintain stability while still allowing banks to conduct legitimate business with affiliated companies. In many cases, Regulation W also requires that affiliate credit transactions be secured with collateral. Collateral provides an additional layer of protection for the bank. If an affiliate fails to repay its obligation, the bank can recover losses through the pledged assets. Acceptable collateral may include government securities, cash equivalents, or other high-quality assets. These requirements ensure that affiliate transactions remain secure and that banks are not exposed to unnecessary financial risk. Regulation W also governs securities transactions between banks and their affiliates. Banks may sometimes buy or sell securities with affiliated companies. However, these transactions must follow strict rules to prevent risk transfer. For example, an affiliate could attempt to sell risky securities to the bank in order to remove those risks from its own balance sheet. Regulation W prevents this type of activity by regulating how securities transactions with affiliates are conducted. These safeguards ensure that banks do not unknowingly absorb financial risk from affiliated companies. Another important principle behind Regulation W is preventing conflicts of interest. When companies operate under the same corporate umbrella, there may be pressure to give preferential treatment to affiliated businesses. For example, a bank might be tempted to offer better lending terms to its affiliate than it would to an unrelated company. Regulation W prevents this by requiring that transactions between banks and affiliates occur on market terms. This ensures fairness and protects the bank from making decisions that could harm its financial position. Let's look at a practical example. Imagine a bank that is part of a financial group that also owns a mortgage company. The mortgage affiliate wants the bank to provide funding for its lending operations. Before doing so, the bank must determine whether the transaction falls within Regulation W limits. The bank must ensure that the credit exposure does not exceed the allowable limits and that any required collateral is properly secured. By following these rules, the bank can support the affiliate while still maintaining financial stability. Because Regulation W contains detailed requirements, banks must implement strong compliance monitoring systems. These systems track affiliate transactions and ensure that exposure limits are not exceeded. Compliance officers and risk management teams monitor credit extensions, collateral requirements, and transaction thresholds. Effective monitoring helps financial institutions detect potential violations early and maintain regulatory compliance. Oversight of Regulation W is carried out by federal banking regulators. The Federal Reserve establishes the rules governing affiliate transactions. Meanwhile, the Federal Deposit Insurance Corporation, or FDIC, plays a key role in protecting depositors and supervising financial institutions. These agencies conduct examinations and enforce compliance to ensure that banks follow Regulation W requirements. Their oversight helps maintain trust and stability within the financial system. Let's summarize the key takeaways from this module. Regulation W limits how banks interact with their affiliates. It places restrictions on credit extensions, securities transactions, and other financial dealings. The rule establishes exposure limits of 10% per affiliate and 20% in total affiliate transactions. Collateral requirements and market term rules help ensure that these transactions remain safe and fair. Together, these safeguards protect banks, depositors, and the overall financial system. Understanding Regulation W is essential for anyone working in banking, compliance, lending, or financial risk management. These rules ensure that banks can interact with affiliated companies responsibly without jeopardizing financial stability. As we continue this Get It training series, we'll explore additional regulatory frameworks that shape how banks operate safely and transparently. This content is for educational purposes only and is not legal, compliance, or financial advice. Please consult your compliance team or a qualified professional before applying any regulatory guidance.